Welcome, Étienne and Brendan. I have to say I'm looking forward to this session. I like that the name is the future of investing because I think it's important that everybody realizes now that Fidelity is no longer just a mutual fund company. We've got ETFs, all different kinds of ETFs. We've got liquid alternatives. We've got OM products. We're really expanding the lineup of what we offer to our advisors and our investors. So one thing that we really love to do at Fidelity is to look at flows, so industry flows, because it really tells us what are advisors purchasing, what are investors purchasing, where's the money going, how are people constructing portfolios. And both of you have a really great lens into flows in the industry. So let's start there. And Étienne, if I can start with you.
Sure.
What are some of the trends that you're seeing from flows in the industry?
Yeah, absolutely. And I think the first thing that we can notice, if we just look at from a vehicle perspective, like the ETF industry in Canada has been growing at an extremely rapid pace over the past, I'd call it since post-COVID, to be quite honest. And I think last year was a great indication of that. $76 billion in net new assets going into the Canadian ETF industry. That was a record year. And so far this year, even through this little period of volatility that we've seen obviously over the past month and a half, has been extremely resilient. We've seen about $39 billion of net new dollars coming into the Canadian ETF industry so far this year. April being around 7 billion. So a bit of a slowdown in April, but nonetheless, still very positive. And I think some of the key takeaways that we've seen from the flows, but also in both Brendan and my roles, we do interact with advisors quite a bit. It's a lot of what we do in our day-to-day. And obviously one of the key themes, and we've heard from our PMs just from a portfolio management standpoint, looking at international equities, in my 8 years kind of in this role, I've never seen so much more flows going into international equities relative to US equities. It's about 10 billion so far this year in international equities to about 5, let's say, in American or US focused equity mandates. Indication that we're looking outside of the US for opportunities, probably a lot of advisors and investors rebalancing their portfolios just because by design or simply due to performance of the past couple of years, the US leading the way, that's become a smaller allocation in the portfolio. A couple other things of note, more recently, really kind of post Liberation Day, we've seen low volatility ETFs come back into play. That's a investment style, if you will, that really focuses on downside protection, lower beta, lower standard deviation or earnings per share, even to a certain extent. That really picked up in demand. I think it's just indication of a bit of a risk-off type play. And then on the fixed income side, it was really, really hot, I'd say, like in terms of flows up until April, which if you take out money market, there was basically nothing that went into fixed income in April, which is quite of a surprise. But those are...
What about... on the ETF side, active versus passive? I'm sure you all noticed Mark Schmale was wearing his Finn hoodie. Dave, who's coming on next, has his long short product is in an ETF. Are you noticing trends going into like factor versus active versus passive?
Yeah, for sure. I mean, obviously here at Fidelity, we don't offer, other than our Bitcoin ETF and Ethereum ETF, which are more passive in nature, we don't really have any market cap weighted index type strategy, which is the definition of passive. We focus on strategic beta, factor-based investing, and then active. Also, to your point, we've got a lot more of our funds available in ETF series, and that's really been a growth segment in the Canadian ETF industry. Obviously, the large chunk is still in these passive type strategies, but if you look at like the CAGR, if you will, over the past 3-5 years, so compounded annual growth rate, it's really actually accelerating on the active and factor side, which lines up perfectly for us. But I think it just shows that there's just more and more options out there for investors, for advisors. There's just more and more vehicles that you can use. And quick little cool nugget, actually, in February was the first time that we saw a month of flows in the US where there was more active ETFs bought in the US than passive ETFs. And that actually flip-flopped right back in March, but still, nonetheless, it was quite unique scenario that we saw. So I wouldn't be surprised to see that continue as we move forward.
Interesting. Brendan, what are you seeing on the alternative side of the business?
Yeah, so I think we definitely play in a bit of a different snack bracket with respect to dollar terms relative to the entire ETF universe. But what I would say, talking in percentage terms, is we can pack a mean punch when it comes to alternatives. The space grew 33% year over year, March to March. So as a Q1 this year, the space grew at 33%. That's a combination of net new flows as well as sort of appreciation of the underlying. When we look at the alternative landscape, we can divide the world into several different categories. That's alternative equity, credit, market neutral, other, as well as multi-strategy being self-explanatory, a combination of the underlying. And on a year-to-date basis, as well as more of a longer-term trend, say 6 to 12 months, we would very much see the alt-focused equity and credit spaces. And what those spaces are, respectively, is areas that use equity or stocks, if you would, in a long-short capacity, and then respectively for bond or credit instruments to achieve just different and more defined outcomes than a traditional long-only portfolio. It's not to say they're better, they're just different and they're deploying a new tool. I often say that a long-short fund or the long-short framework is really the truest expression of active management in that we do all this research, we identify companies we love, and inevitably we buy them. We identify companies that we like less, and typically the best we can do is zero them out or avoid them. But with respect to the long-short framework, you can take that research and put it in action, and not to mention that shorting is also a source of leverage for investors to, at times, get some off-balance sheet financing and have more than 100% exposed to markets. So from a flow standpoint, it's very much the equity and the credit side. 2024 was, of course, a big story with respect to digital assets. So digital assets do fall under the alternative category. We might be getting a little bump in that space today for that matter with respect to some of those products.
Bitcoin's back in the headlines.
It very much is. So, I mean, there's a lot of exciting things going on. I know that if you spoke to our director of alternatives, Rory Poole, he's building out a small army with respect to his team. We're figuring out where market demand is, where our capability is, and how we best align those to come out with meaningful product for quarters and in years to come. But I do think we have a long runway. A good example of that is our OM-based product, a private real estate mandate that we actually just launched on March 17th of this year, Fidelity Alternative Real Estate Trust. So we're thrilled to be now playing in a new space for Fidelity Canada, which is that of in the private universe. And we'll get to that a little more later.
Just given that there's a lot of volatility happening in the marketplace right now, let's just stick with alternatives. What solutions do you, out of our lineup, do you think sort of best meet the needs of investors in these volatile periods?
Well, you're going to be mad at me. I'm going to say all of them in a sense that like all of them have achieved their, if we look under the microscope of what has been sort of, I don't know, 5 and a bit months kind of thing. Each of them has achieved their objectives that they've set out under the microscope that is this landscape. Some in particular have provided materially positive returns, global value long short. We heard from Dan Dupont earlier today. And I think that if you look at what these vehicles are designed to do, they're not necessary. Some of them are all-weather vehicles, but some of them are for specific environments where they will add outsized value. And I think that on a year-to-date basis, you take a fund like Market Neutral, long-short alternative with Dave Way, who we're going to hear from next. For those in the crowd, if you haven't heard or online, if you haven't heard from Dave Way yet, please make sure to tune in. Him and his fund, it really is something special. Over the last 4.5 years, he's essentially gone out and achieved every objective that he set out in October of 2020 when he stood the fund up. So I won't take any more.
We've seen incredible flows too, right? In long-short alternative in recent months?
Very much so. I mean, not to quote a specific number, we've done several $100 million on a year-to-date basis with respect to flows. The fund is approaching about $1.4 billion in size. And we used to kind of call it the best kept secret on Bay Street. And I think it's becoming less of that, if you would.
Not anymore.
Yeah, right. And I think that it was actually in March when volatility crept in, what was working. We often quote that Feb 19th date when things sort of changed. What was working stopped working, and it caused a lot of those who allocate capital and manage money to revisit, hey, what is my approach? Is there some rearranging of the house that I can do to kind of best position myself for the remainder of 25? I'm rambling here, but we saw $100 million of net inflows in one trading week. Like, wow. You start to think about it, it's a $1 billion fund that did 10% of its AUM in a trading week. And what that was, it's a lot of the efforts of our various sales teams in getting this on the radars of many that essentially didn't make a ton of changes while things were working so well last year. So I see this fund going to bigger and better places for sure.
Wonderful. Étienne, on the ETF side of things, what in our lineup is looking like a good position for you right now?
I mean, we've got more than 50 ETFs now, so it's hard to choose. Hard to choose an exact strategy. But I kind of take a step back once again and look at, given the current environment. Actually, we heard from Mark not so long ago saying, taking outsized bets right now is probably a challenge, right? So it's kind of positioning ourselves from a core perspective, thinking of how we can take advantage of certain inefficiencies and just broader market cap weighted indices. And so that kind of brings me back to two products that we launched a year ago. It's our All-American Equity ETF and All International Equity ETF. Those two are a multi-factor type approach where we're actually combining 4 of our individual factor approaches together to remove a lot of the cyclicality that you see in individual factors, right? So you go out and you buy a value ETF. It has its time in the sun, but it's naturally, as we have a change in the business cycle and moving along the economic cycle, it can go in and out of favor. The long-term benefits of each factor has been proven over time, but they are cyclical. So with these approaches, we have, similar to our all-in-ones actually, we're combining multiple factor ETFs, so underlyings, I guess it's an ETF of an ETF structure, to give you a more consistent experience and giving us a higher probability of generating that alpha. Maybe a bit less alpha, but more consistently. And that's really the approach that I think resonates a lot right now. And actually, for 2 specific reasons, those products in general that I do like. One, I mean, if we look at the all international equity, it falls in line with the demand for just international solutions. And the way that I like to talk about that one in particular is when we look at the actual index, right? A lot of advisors, investors, when looking at international, they tend to gravitate towards 2 main types of solutions. One is through an active manager that has, displayed a strong track record over time or has a specific investment style that fits maybe the needs of those investors. Or the other option has historically been let's just buy the MSCI IFI index via an ETF. The issue with the MSCI IFI index is, I guess not the MSCI IFI index in general, but not all indices are built the same, right? So when you buy, say, an S&P 500 ETF and you buy an MSCI IFI tracking ETF, you're not comparing apples to apples. So the MSCI IFI index in itself is significantly broader, 1,600 or so names. There's no inclusion criterias, right? So you're just got to be big enough and have enough liquidity. The S&P 500, that's not entirely true. It's a lot harder to outperform the S&P 500. Naturally, you have quality screens embedded. How long did it take Tesla to be included in the S&P 500? It took a long time because you needed positive trailing 12-month earnings as well as the last quarter. So when I look at the international market, it gives us a much better opportunity to highlight, I guess, if you will, the work that we do under the hood, which means higher batting average being our consistency of generating alpha. So I'd like that one for that in particular.
We've seen a lot of flows into our all-in-one ETFs. So I think over 50% of our assets on the ETF side of our business are in the all-in-one suite.
Yeah.
So talk to us a little bit about how we construct those ETFs and why you believe they've seen such great traction over the last few years.
Yeah, well, obviously, thank you to everybody in the room here. So far this year, like you mentioned, we've had, obviously very good flows into our ETF lineup as a whole, about 3.2 billion. Slightly more than 2 has been into the all-in-one ETFs, which are these ETFs of ETFs or funds of funds, if you will, where we're trying to build extremely core portfolios, very diversified, as much from a geographic standpoint, from a style standpoint, obviously with a different, getting exposure to low volatility names, high quality companies, momentum, value, et cetera. We combine systematic investing, if you will, factor investing with active management in certain areas, like our global small cap opportunities ETF is part of the mix. Our global core bond ETF is also there. That's actively managed. And the objective is to have these strategic exposures where we manage risk for investors, but we're not trying to take, tactical asset allocation calls. And one of the benefits of that is we have consistency in risk profiles. So for investors that want to buy a 60-40, for example, well, it's pretty much going to be a 60-40 at all times. So there's a bit of clarity around that. The way that we rebalance these portfolio also allows us to really manage risk, but then also benefit from shifts in momentum. And the way that I say that is, since we've launched these portfolios, FBAL and FGROSS are our all-in-one balance, all-in-one growth, and all of these are available in mutual funds as well, right? I don't know the codes by heart, unfortunately, but our all-in-one balance and all-in-one growth, which we launched in 2021, we've seen that they've consistently been able to achieve their objective, which is outperform kind of the passive ETF portfolios in this space. We've done it every calendar year. So even in a market like 2022, which was completely different than 2023 and 2024, which were a lot more similar, I'd say. It's kind of a testament of the construction process that we've put in place. Like last year, momentum was the main driver of performance in the portfolios. This year, it's low vol and value. So having this mechanism of staying close to the neutral mix allows us to create a really strong, consistent experience.
So we're using, as flows are coming in, we're always we're using the flows to rebalance the portfolios, which is also sort of nice from a taxation standpoint. taxation standpoint as well, right? It's a bit more tax
it's
efficient.
It's a great side benefit, I'd say.
Yeah.
The idea is, as flows come in, instead of buying the neutral mix, like let's say we get $1, we're not going to go out and split that dollar to what was shown on screen earlier. We're going to, buy up the things that have underperformed so that we get back closer to that neutral mix. And that at the end of the year, when we do our annual rebalancing period, maybe there's less to sell to get back to the neutral mix. So it's definitely a good structure. I mean, very cost effective. And, for those that haven't checked them out, I encourage you to, because the performance has been very strong.
Brendan, there is a digital asset in these all-in-one ETFs, Bitcoin. So tell us a little bit about why we included Bitcoin in these all-in-one portfolios. And I think it's important to point out as well that Fidelity, I think we're the first company to add a cryptocurrency to a multi-asset product. So tell us a little bit more about why we did that.
Yeah, absolutely. And I think that I'll just start by saying it was last January that the US launched exchange-traded funds in the digital asset space. So Canada had this landscape long before the US in that respect. And we just exercised that flexibility to, essentially, the flexibility we have is to include up to 10% of a non-conventional fund, according to national instruments, so an alternative, into a conventional fund. And that's exactly what we did. So investors of the all-in-ones have anywhere between a 1 to a 3% exposure to Bitcoin. We do feel for those that are managing money that have clients that are asking about the space that it's an excellent vehicle to kind of get exposure to digital assets without necessarily bringing it onto the statement as an individual line item. That said, if you do wish to get exposure to the underlying, we do have FBTC, very much a leader in the digital landscape, leader on price, leader on custody. We do this front to back. There are no other sort of third parties involved. We have Fidelity Digital Asset Services out of the US who we use for the custody and safekeeping. So very much a leader in that space. But back to the initial question, which is the why for the inclusion. And I think it goes back to the fundamental message that would be the argument for inclusion of alts in general. And that's that anytime you have the opportunity to bring a building block into a multi-asset portfolio that is less correlated, but longer term through the noise is going to compound at an attractive rate of return that helps meet objectives. So if that rate of return is on for example, it's 8 to 10. If something is going to long-term provide you something in that neighborhood, but be less correlated to the existing stocks, whether it's investment grade, fixed income instruments, investment grade, high yield, or the stocks for that matter, whether they are growth, value, or the various other factors, I think that that's a huge win for investors. And we do see that even just as recent as year to date, a lot of the damage in digital assets or the price of Bitcoin, which is most often quoted, was seen long before the turmoil that we saw in equity markets, be it 4 to 6 weeks ago. Digital assets, essentially, I'm not saying they priced it in ahead of time because that was by no means what happened, but they held up while equities were selling off because they'd already gone from like 108 to 85 in the months and weeks earlier kind of thing. But I think that investors just win by diversification.
Mm-hmm. Just on that point, I mean, you talk with a lot of advisors. One of the most painful parts of 2022 was the strong correlation between stocks and bonds. So post 2022, have you noticed that a lot more advisors are increasing the alt exposure in their clients' portfolios?
I feel like a broken record quoting 2022. And the other aspect is mentioning the positive stock bond correlation. Like if we just throw up the US Ag and that of equities and kind of look at the correlation of one another, it's been painful. And 2022 is a good poster child for that, if you would. Stocks and bonds moved in tandem, depending on your geography or your duration exposure. You were down 10 to 18% on a balanced fund at different points throughout that year. And that's problematic, right? So when I talk about alternatives, I kind of use the proverbial third leg on the stool, right? Like alternatives are a tool to help make portfolios sturdier for today's ever-changing markets. And I think that if we'd use the turmoil sort of that came on February, March-ish of this year, we have seen traction come onto our alternative landscape. I've been a little busier since things have gotten a lot less certain and up and to the right. And I think that is very much a call to action for alternatives. And education is a big thing. I think that when it comes to how individuals conduct their practice, how dealers on average conduct what products are approved and whatnot, education is a big component of the alternative landscape. Like I know that years back, there were many a dealer that would auto blanket a new solution if it had the word alternate to high, regardless of how it was structured. Like we have market neutral, for example, runs with a standard deviation of like 4.5 to 6. It would very much go head to head with a low risk fixed income mandate, and it might be high at certain dealer gatekeepers. That's totally okay. I get it. We need to understand what we're approving. We need to understand how these things behave. And I think that as we get more educated about what these tools offer, we're going to see them end up in more portfolios. So the space is about $58 billion in size today. And if we use that as the numerator and just do all retail Canadian AUM, we can make the inference that there's less than 1% of investor capital in alternatives today. We work with dealers. There's a notable IROC dealer out there today that just expanded their ceiling or their maximum on alternatives that their advisors can manage up to 25% and 25% for liquid alternatives and illiquids respectively, or privates. So that means that these advisors can allocate up to 50% of their models and or portfolios to alternatives. And mind you, that's a ceiling, that's a maximum, right? Like we most frequently chat with people where they start at say a 10%, a 20% sort of earmarked portion of a portfolio.
But it's sort of indicative of what we can see happening in the future.
There's a long runway for sure.
Yeah. So Étienne, on the all-in-one side, there's just 4 all-in-one portfolios, but we just got reseeded this week because we're adding 2 more to the lineup. So tell us a little bit more about the additions that we're making to the all-in-one ETFs.
Yeah, no, absolutely. Unfortunately, the slide is slightly outdated now. We actually got reseeded for two new additions to the all-in-one ETF lineup this week. So we're very happy to announce that. As you could have seen on the screen, we have, I guess, our most conservative option right now is 40% equity. 60% fixed income, give or take. Obviously, we have that little 1% in crypto. And, we were seeing the demand for more conservative options, obviously, as the population ages, generally just speaking. More demand for kind of risk-off type mandates, given the volatility. Somebody that was maybe a 40-60 might be looking to move to a 20-80 just because we're at a point where I'm not willing to take on more volatility. So we're going to be introducing 2 new versions. One, our all-in-one conservative income all-in-one ETF and fund. That's going to be a target of a 20-80. And then also just to round out the lineup, because we do have an all-in-one equity, which is 97% equity, 3% crypto. We're going to an all-in-one fixed income, which is 100% fixed income, so none of the crypto allocation there. But we're just really excited about rounding out the lineup. A lot of new stuff coming out, and as you all know, we love to launch new products at Fidelity. We're always looking to innovate. We're always looking to find solutions to fix new problems that might exist that maybe didn't exist 5 years ago. Like 2022, Brendan was mentioning, it was a very challenging year because there's no real place to hide. Obviously, alts are a great solution to that. But then we're always looking for other areas that we can reduce correlation in portfolios. And I think this year's another kind of testament. It's kind of the opposite testament, if you will, to 2022, where, if you did have international equities, that's offsetting. If you had a bit of bonds, it helped for the most part, other than that kind of little rise in yields that we saw on the long end in the US. But this, a balanced portfolio, and I'm sure many advisors in the room here today have been called by their investors saying, what's going on with my portfolio? I've seen all these headlines around volatility. So I think, diversification is back at the forefront, and we're always trying to find ways to add more tools to that toolbox.
Yeah, I think that's the beauty of what we do at Fidelity. We're always looking at the future, as you said, how we can innovate. We're always listening to our advisor feedback. Yeah. So keep an eye out for an email from your sales team about some of our new products that are coming out in the next couple of weeks. Brendan, you mentioned the FARET, which is the real estate alternative investment trust that we're launching with Brookfield. So just give us a little bit of insight into what that product is, how that partnership with Brookfield and Fidelity came together.
Yeah, so Fidelity Alternative Real Estate Trust. We launched it on March 17th of this year. We're thrilled to be in the space. To go to the genesis, we would actually have to go back to 2023. When we stood up the strategic agreement with Brookfield. Really what it is we stand to access their expertise in what are decades of experience in the private asset world. And in particular, they manage over $270 billion in real estate. And I think that the pedigree that they bring forth, I know that we've been very impressed with what they bring to the table from a due diligence and analysis and sort of their strength in transacting, knowing what's going on in the Canadian landscape, getting deal flow as far as what's selling, who's buying, who's listing. And essentially what they've done is they've purchased to date 6 properties for us. So from Vancouver to Montreal, we have, and again, I'm going to ballpark here, we have about 700 to 800 million of exposure to private Canadian real estate. And when we've used our private investment pools to get that off the ground, to stand up the fund, and now we're offering on a standalone basis to investors here in the Canadian landscape. So we're thrilled about that. We're thrilled about the pedigree of Brookfield and to roll out a product in this space.
That's wonderful. In the last couple of minutes, Étienne, I'll pass it to you. Just leave us with a final thought for the group as we wrap up.
Final thoughts. I think one thing that I like to highlight is, our objective on the ETF team is very similar to that as our active portfolio managers, which is to create value for shareholders, right? Or unit holders of our products. We're not going to be in the space of passive investing on the ETF side, which is something that had been around for a very long time. Our strategy is product differentiation. It's not cost differentiation. We want to generate alpha over time. We've so far shown to be able to do that, so we're very happy. But that's really our key objective as well on the ETF side, just like it is on the active fund management side, albeit we take a bit of a different approach with more of a quantitative one. Ideally, the result's the same.
So that was Brendan and Étienne on the future of investing at Fidelity. Thank you very much for your insights today.
Pleasure.
Thank you.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.